Welcome back to the Deep Dive. We track the Bitcoin intelligence briefing every week, as you know, but the picture right now, it's really quite conflicted. What we're seeing is, well, a market just defined by this massive divergence.
Yeah.
You've got the short-term sort of nervous tactical pause happening,
Yeah.
driven by macro stuff.
Right.
But at the same time, there's this relentless foundational institutional build-out happening for the long haul.
That tension is exactly what makes this briefing so interesting, I think. For you listening, the immediate thing is Bitcoin's in this consolidation phase. It's trading just under, what, $114,000?
Yeah.
And this is all driven by real caution, a market-wide risk-off feeling ahead of the U.S. Federal Open Market Committee meeting.
The FOMC. Always looms large.
Exactly. But yeah, this short-term jitteriness is happening while behind the scenes, major regulated infrastructure is taking these huge leaps forward.
Okay, let's unpack that immediate caution first then. Because the short-term numbers, they're pretty clear.
Yep.
Over the last 24 hours, Bitcoin, it slipped about 1.4%, back down to around $113,873.
Right.
But like you said, this isn't just Bitcoin traders getting, cold feet.
Yeah.
The whole global crypto market cap is down. And big names like Ethereum, they fell over 3.5%.
Yeah, quite a bit more. It really points to a systemic de-risking thing going on.
So where are we seeing that in the charts, the technicals?
Well, we can definitely confirm that pause in the technical data. Bitcoin's basically stuck consolidating tight around that $114,500 level.
Okay.
So traders are watching two main lines. You've got resistance, the level the bulls need to crack, that's $116,400.
Right.
And then immediate support is lowered down at $111,400.
There's a pretty defined range for now.
Exactly. And what's interesting is while the price is stuck in this range, the fear and greed index, it's actually improved.
Oh.
Yeah, it moved from fear back into neutral. So it suggests the underlying panic has eased off a bit. But the market's still just holding its breath.
And it's holding its breath because of one main event, isn't it? That FOMC meeting on October 29th.
Absolutely. That's the focus.
And the weird thing is, the derivatives markets, they've basically priced in the outcome already. Like a 98.3% probability of a 25 basis point rate cut.
Yeah, almost a lock.
So if the rate cut itself is pretty much a done deal, what is the market actually waiting to hear?
That's the key question, right? The market seems to be almost ignoring the rate cut itself. It's all about the Fed's statement that comes with it.
The commentary.
Exactly. And most critically, their forward guidance. Specifically, traders are laser focused on any signals, any hints at all about potentially ending the quantitative tightening program, QT.
Right, QT, where the Fed shrinks its balance sheet, takes liquidity out.
Correct. So if they hint they might stop QT or even slow it down significantly, that signals future liquidity coming back into the system.
And that dictates the next move for risk assets.
That's what will likely determine the next big short-term trend for everything from stocks to crypto, including Bitcoin.
Okay, but we need to zoom out a bit here too. Connect this to the wider world. While the Fed might be thinking about easing up, maybe injecting liquidity, the IMF, in their latest World Economic Outlook for October 2025, they're projecting global growth to slow down from 3.3% this year to 3.2% next year. They call the outlook dim.
And that link is absolutely vital. If you connect the dots, the reason the Fed might be cutting rates or thinking about stopping QT, it's precisely because they're likely seeing the same underlying global economic fragility that the IMF is highlighting.
Ah, okay. So the potential easing is a reaction to weakness.
Could be. So yeah, we might get a rally after the FOMC if the Fed sounds dovish, driven by liquidity hopes. But that rally could be pretty fragile if it runs straight into a weakening global economy. It kind of puts a ceiling on how excited the market can get.
Okay, so while the Fed and the IMF are sort of worrying about the global economy's speed limit, it really seems like the smart institutional money is just ignoring the immediate fog. They're putting serious capital to work.
That's the other side of the divergence. We saw $921 million in net inflows into regulated crypto investment products just last week alone.
Wow, $921 million.
Yeah. It really confirms this profound shift that's been happening in the sector.
A conceptual shift, you mean?
Yes, exactly. The focus, it's moved beyond just providing access, just letting institutions buy some Bitcoin.
Right, like the early ETF days.
Exactly. Now it's about full-scale integration, weaving this stuff into the existing financial plumbing.
Okay, give us an example.
Exhibit A, I'd say, is USDC Issuer Circle. They've just launched the public testnet for something called ARC.
ARC. Okay, tell us about ARC, because this sounds like more than just another blockchain.
It is. ARC is a new Layer 1 blockchain, but it's specifically engineered for global financial firms.
Oh, so.
Well, a couple of key things. It actually uses USDC, their stablecoin, as its native gas token.
Oh, interesting. So no volatile crypto for fees.
Exactly. That removes friction and volatility right away. It also features instant settlement and has built-in privacy options that are tailored for compliance needs.
So using USDC for gas. That means transaction costs are stable, predictable, fits right into their existing treasury systems.
Precisely. It removes a major operational headache.
And who's involved?
Yeah.
Does this have real backing?
Oh, yeah. The participants list confirms this isn't just some theoretical project. Over 100 institutional partners are already involved.
Like who?
We're talking the heavy hitters.
Yeah.
BlackRock, BNY Mellon, Goldman Sachs, Visa.
Wow.
Yeah. ARC is basically infrastructure being co-developed by the biggest names in traditional finance for their own use.
That's huge. And that kind of deep infrastructure build-out, it must demand new levels of trust and transparency, right?
Absolutely. Which brings us to another development. Virchin, they're a Swedish ETP issuer, manage about $450 million.
Okay.
They're now using Chainlink's Proof of Reserve.
Proof of reserve, what does that do for them?
It provides real-time on-chain verification that their physically backed products, the ones holding actual crypto, are fully collateralized.
So cryptographic proof that the assets are really there.
Exactly. And this is a massive step for regulatory comfort and institutional trust because it offers that transparency without forcing the fund manager to, say, reveal all their specific wallet addresses or sensitive operational details publicly.
Got it. Transparent proof without giving away the keys to the kingdom.
Well put. Yeah.
And we're also seeing stablecoins themselves moving deeper into the actual payment rails, bridging legacy finance and digital finance.
Right. Tune, a global payments firm, just launched a service enabling payouts via USDC and USDT directly into global wallets.
So businesses can send cross-border payments using stablecoins.
Effectively, yeah. They're merging fiat systems and stablecoin systems through a single API. It's mainly for B2B cross-border payments right now.
It really shows stablecoins becoming less speculative, more like core operational tech for companies.
That's exactly the trend. Enterprise finance adoption.
And this structural commitment, this build-out, it's not just about Bitcoin and Ethereum anymore, is it?
No, definitely not. The regulated product market is clearly maturing. We're seeing what you could call a second wave of products launching for alternative Layer 1 networks.
Okay, like what examples are standing out there?
Well, over in Europe, CoinShares just launched a physically backed ETP for Toncoin, T-O-N. It's listed on the 6xly exchange.
Toncoin, associated with Telegram.
That's the one. And the structure is really interesting for institutions. It has a 0% management fee.
0%.
0%. And it passes on a 2% staking yield directly to the holders.
Wow, okay. 0% fee plus a 2% yield. That's pretty attractive.
Incredibly attractive for institutions looking to optimize returns and minimize costs. And the rationale, like you hinted, is TON's direct integration with Telegram's enormous user base, over 900 million active users. That's a huge potential market.
Okay, so that's Europe. What about the US? Are they catching up with these Alt L1 products?
They are, but with a very different type of asset. Canary Capital just launched the first spot Hedera ETF HBAR on NASDAQ.
HBAR. Now, why would institutions who usually prioritize safety and decentralization why look at HBAR? It's known for its corporate counsel.
Right, exactly. It really comes down to that governance model. HBR is governed by a council made up of major global corporations, Google, IBM, Dell.
Right, not exactly cypherpunk anonymous devs.
Not at all. It's the complete opposite of the decentralized open source governance you see with Bitcoin or Ethereum. But for certain capital allocators, that corporate oversight provides a kind of safety net, predictability. Operational stability they find very appealing when they're deploying large sums.
Interesting. So different governance models attracting different types of institutional interest.
Precisely.
And this diversification we're seeing in products, is it showing up in the actual money flows too?
Absolutely. It's mirrored perfectly. So you still have Strategy Inc. That's the company formerly known as MicroStrategy.
Right. Still stacking sats.
Still stacking. They added another $43.4 million worth of Bitcoin to their treasury. Consistent corporate accumulation.
Okay.
But on the other side, BlackRock spot Ethereum ETF recorded a massive single-day inflow of $72.5 million.
72 million into ETH in one day. That's significant.
Very significant. And that difference, $43 million into BTC versus $72 million into ETH on that day, it suggests a strong capital rotation theme is playing out.
Meaning institutions are moving beyond just Bitcoin.
Yeah, they seem to be strategically diversifying beyond their core Bitcoin position into assets with distinct use cases, like Ethereum for DeFi or for RWA tokenization, real-world asset tokenization.
Right. RWAs are a big theme.
Huge. So ETH offers these different growth paths compared to Bitcoin's main store of value narrative.
And even the way companies manage their crypto holdings is getting more sophisticated, right?
Yeah.
Beyond just buying and holding.
Yes. Metaplanet, they're the Japanese public company that also has a Bitcoin strategy. They initiated a share buyback program.
A share buyback. Why is that particularly important in this context?
Because it shows they're treating their Bitcoin not just as some static asset on the balance sheet, but as an active tool for financial management.
Oh, so.
They explicitly used the buyback to try and narrow the discount between their stock price and the actual net asset value tied to their Bitcoin holdings.
Ah, so using the Bitcoin position to directly influence and manage their own shareholder value.
Exactly. It sets a precedent for using BTC almost like a treasury stock, an active financial instrument.
Okay, so this rapid institutional adoption, the financial tools getting more complex,
Yeah,
it naturally invites more scrutiny, doesn't it?
it absolutely does.
Which brings us nicely to our final segment on geopolitics and regulation.
Mm-hmm.
Because if integration is speeding up, the regulatory landscape must be shifting just as fast.
It is indeed. Look at the EU. They just adopted their 19th sanctions package against Russia.
Okay, another sanctions package. What's new here for crypto?
What's crucial, and really a first, is that this package directly targets crypto infrastructure itself,
Infrastructure.
not just individuals or companies. Right. The sanctions specifically ban the developer of a widely used ruble-backed stablecoin and also an associated trading platform.
Wow. That's a big shift.
It's a major precedent. It moves the focus from sanctioning users of crypto, which they've done before,
Yeah.
to sanctioning the actual protocols and developers behind them.
That seems like it could set a dangerous precedent. It creates huge compliance challenges, surely.
Massive challenges. And yeah, it could potentially lead to market fragmentation, as different geopolitical blocs might start using regulation to target specific digital asset projects they don't like. Sanctioning Kund, essentially.
Okay, that's a pretty concerning development. But is there a counter-narrative here? Something more positive about digital infrastructure?
There is actually a fascinating counter-narrative.
Yeah.
It illustrates how this same digital infrastructure can potentially drive self-determination, kind of pushing back against centralized control.
Oh, tell us more.
DMG Blockchain Solutions has expanded its partnership with the Malahat Nation in British Columbia, Canada.
The Malahat Nation,
Yeah.
an indigenous group.
Yes, and the plan is really ambitious to create an indigenous-led AI data center campus.
All right.
And critically, it's going to be supported by an indigenous-led regulated utility.
Wow. So controlling their own energy and data infrastructure?
Exactly.
Yeah.
And the Malahat Nation chief explicitly framed this as an act of sovereignty, a way to control their own energy, future, and economic development.
That's powerful. And it must have strong ESG appeal too, right? Environmental, social, governance.
Absolutely. It provides a very strong ESG case, clean energy, self-determination, technological advancement that could be very attractive for attracting institutional capital into the sector, but in a positive way.
That's a great example.
Mhm.
Okay, and finally, just quickly on the user side of things, any major changes making life easier or harder for everyday users?
Well, adoption keeps getting easier generally. MetaMask, probably the most popular crypto wallet.
Yeah, pretty much everyone uses it.
Right. They just launched a big multi-chain update. It now supports not just Ethereum and EVM chains, that's the standard used by
Right.
tons of blockchains, but also Solana. And soon, apparently, Bitcoin addresses too, all from a single account interface.
Okay, that's huge for usability. Consolidating access across major chains simplifies things massively for the average person navigating this often confusing multi-chain world.
Definitely simplifies things. But as always in crypto, it also immediately sparked a lot of speculation.
Let me guess. A token.
You got it. Speculation around a native mask token launch, especially because some kind of claims portal apparently surfaced alongside the announcement. So watch that space.
Always something brewing. Okay, let's try and pull these threads together. Recap the two big narratives that seem to be fighting it out right now.
Yeah.
For the short-term trader, it seems like volatility is the name of the game. waiting on the Fed's word about QT guidance. That's keeping prices pretty much locked in that tactical range we talked about, between roughly $111,400 and $116,900.
Right. Tactical focus, range-bound action. But conversely, for the long-term strategic investor, all the structural developments we discussed, Circle's arc, Virchin using proof of reserve, those sophisticated HBR and TON ETPs.
Yeah, the deep integration stuff.
Exactly.
Yeah.
All of that reinforces the fundamental investment case. It suggests that any price weakness we see now, driven by this short-term macro event risk, might actually be viewed as an opportunity, because the underlying integration into global finance, that seems to be accelerating faster than ever.
So putting those two narratives side by side, what does it all really mean? We're seeing this massive, bespoke, institutional infrastructure like ARC being built for global finance. At the exact same time that powerful state actors, like the EU, are showing they can and will sanction specific crypto protocols.
That's the core tension right now, and it leads to a final, maybe provocative thought for you to consider.
Okay, leave us with something to chew on.
ARC and other institutional layer ones like it, they're being designed for trust, security, regulatory compliance, deep integration. That's their whole purpose.
Right.
Given this new precedent set by the EU's 19th sanctions package, the idea that the protocol itself can become a target, how will that geopolitical risk influence the fundamental design choices? The governance models of these brand new networks being built for global finance.
They have to be built anticipating that risk now.
They almost certainly have to be built to be resilient against potential state-level action right from day one. That's the huge strategic challenge facing these institutional builders right now. How do you build truly global integrated infrastructure that can also withstand geopolitical fragmentation?
That is definitely something to think about. A deep dive for another time, perhaps.